All right. So the highlight, we'll just get start out from the top is context. We were weak yesterday, closed week, and we did not make any attempt in the overnight session, along with China and Europe, to rally back and take back any of that weakness. So, like we say all the time, is the market weak or cheap? If it's cheap, it rallies pretty easily from some lower levels. If it's weak, it's priced down there for a reason. And so in an overnight session, after a pretty weak session, the prior session, we didn't try to bounce back. In fact, we didn't even rally that much, a couple points from where we closed yesterday. You know, 3 even was the close, 4.5 was the overnight high. So it was a matter of like downsides to the right side, but it's all about timing. When I talked about be careful long at a couple moments, but it's our PWAPs that help us distinguish between when to be bullish to bearish, right? Or bullish to neutral even. And so if I fast forward this and focus on this top chart in our red lines, when we get through it, boom, we're gone, right? And let me go back to here. So we finally get through it in there, and we start using the red lines. Now look at this chart as subsequent resistance. All right. And it's broken down to the lower 40s. And then downside continues to be the right side. But if I break it back into here, look at all the times after where my cursor is, it gets through it. Now we don't know this is going to happen at this moment, but we could objectively start scratching our head that if you are bearish, you could start looking for a time to fire in the ready aim fire approach. And look at all the times, all the instances that this market used the red green PWAPs as overhead resistance. It's not coincidental that it came up to it almost to the tick on many occasions. All right. And so even when it gets above it a little bit, it comes right back down through it. And you see me circling it in real time where it gets back down into it and starts to go bullish to bearish, even if you went a little bullish. Let's say you went a little neutral when this happened, but you turned and went bearish based on where you wanted the market to be, and then look at some resistance as safety for good objective reasons on why that side would continue to be the right side. And there's no coincidence that the red right here where my cursor is great resistance. Right in here, great resistance, comes up and comes off. Again in here, in there, in there, in there, in there. So when you talk about the resistance that this market showed with all these swing highs or congestion box highs or range highs, if this green and red dotted line were Bollinger Bands, that guy would be the king, the queen, the prince, and the princess in the castle. But Bollinger Bands don't work like that. And I'm not shitting on that guy, but I'm just talking about why lines mark on a chart, where they come from, and does it ever come down and get down into the foundational, rational reasons as to why price moves. OPP, other people's positions. And when you plot these lines, as you guys in this room know, as the average of where people are long and short from, and a bigger sample size than anybody else has out there. And most people don't even understand the value of knowing other people's positions and where they're short or long from, or how to use it. They don't even understand it, let alone have the tool that shows it. But if Bollinger Bands work this well, as you guys see it day in and day out, you'd be the king, the queen, the prince, and the princess. So it goes back to ready, aim, fire, your level of progression to not just get bullish or bearish, not just find areas to get long or short, but the fire and ready, aim, fire is the executional moment to essentially implement your idea. And then step 4 being, where am I wrong? And not wanting to be wrong. If you're wrong where everybody else is wrong, then you're probably in a trade that everybody else is in, As you guys know, too many longs, too many buyers, too many buyers. It's hard to go down. Too many shorts. Wait, I said that wrong. Too many longs, too many sellers. Too many sellers. It's hard to go up. Too many shorts, too many buyers, too many buyers. It's hard to go down. You know, as someone who has talked about this since I began in this business, you could still kind of screw up the semantics of it. That's why it's important. And I said this earlier in the room, right? People that have heard this notion of after you buy it, you're a seller. Too many shorts, too many buyers. Even if they heard that, did a little research on it, they still don't understand it and get it and use it. So constantly looking for an edge, that's a place where you want to go, stay, because it's not a one size fits all. But what is a one size fits all? The concept of other people's position. So anybody in here or anybody listening to this in the future, this recording, you can go back in the history of any video I've done, any video Anthony Drager have done. Concepts never change. Because if you go back and listen to someone who's talking about trading and they kind of go with the wherever the wind's blowing, that's the problem. You want to put yourself in a position where, wait a second, the concept should never change. The tools should be able to get better, but not the concepts.